I'm sorry. We actually had live participants too. It's like, well, in the meantime, if something comes to us,
Yeah, what's up?
this isn't working. This is beyond disastrous. I think we're good.
You do it better though.
I think it's good.
Maybe they put it this side.
All right, written exam. Monday, March 9th. We should have good weather. By the way, I know that you weren't all wondering about this, but my daughter did take off yesterday morning. 2 hours after she was supposed to go, but she did go, and she said, she called me from the plane to say, they're de-icing. I know that's what happened to Daddy and Jackie. Is this a good thing or a bad thing? I said, well, it's a good thing that they're de-icing. I said, but you have to wait. But she did get there. She got there 2 hours late, and she took off from JFK, fortunately, because what happened up in LaGuardia was a disaster. Although, as my husband said, there's no such thing as a bad plane crash, better than you walked away. So, that was a good one. We survived that one, but the airport was shut down. All right, so your exam is going to have 3 problems. Problem 1 is current liabilities. There are 2 parts to it, all right? Part A and Part B. And Part A is either going to be warranties or premiums. Not extended warranties. All right, so I'm going to be asking you what's the warranty expense and what's the accrued warranty liability, or what's the premium expense and the premium liability. So warranty expense or premium expense and liability. For 2 years. And I'm throwing in a curveball. I'm telling you what the curveball is right now with a change in estimate. And we're going to try to do an example of that in a few minutes, right? So I'm putting in a change in estimate. So it's not only going to be a warranty or a premium, but it's also going to be something where we change our estimate over that 2-year period. All right, so we'll see that in a minute. Next thing is going to be a loss contingency. All right, and this is also going to be over 2 years. All right, so I'm going to put it this way. It's not as simple as the sound audio question that you had for homework. That's the company name. But not as difficult as the EY question that we did in class. All right, so I know I'm being a little bit vague, but I'm telling you, study those 2 things and combined, they're going to be fine. The best thing actually to do would be to study the one that we did in the PowerPoint slides, where we did the IRS tax contingency. All right, so also look in PowerPoint notes on IRS tax contingency. All right, so if you go to the IRS tax contingency one, we said, you know, what do you record as your liability and your expense? And then what happens after the end of the year if you settle it for more or less than what you recorded it for? That's what this problem is going to be like. All right, so it's going to be much shorter than the Ernst & Young problem that we did in class, but it's going to be more complicated than the sound audio question that you had for homework. So it's somewhere in between those two. And you are going to have to do journal entries for this second one. All right, so there will be journal entries. There's no journal entries on the first one. Okay? That's problem one. And so it's several small parts. It's not a long problem. It's long when you put it all together. Problem two. Bonds payable. All right, I think I've said this to you guys several times over. It's either going to be an amortization table or a question along the lines of, I believe it was Bradford that we did in class discussion. You'd have to calculate the present value of the cash flows, or a full problem calculating present value of cash flows and preparing journal entries. So I don't know if any of you guys were looking at the Blackboard website yesterday. Probably not, but you will see that I've completely reorganized the sample exam page. All right, and I posted some additional sample exams, and I also pulled off some stuff that I just thought was old and stale. All right, so I'm actually going to take you to that right now. I'm going to go to the sample exams. This is completely revamped all the way down. I combined and consolidated some of the stuff so it doesn't say questions, answers, stuff like that. So it was a snow day. Cleaned up this whole section. So now what you have is the Accounting 124 exam from fall of 13, the Accounting 124 exam from spring of 14. If you want to get a really good idea of what to do, what a bond problem will look like, you'll see that in spring of 14, they had a bond amortization table. And in fall of 13, they had to do present value calculations with all the journal entries. So I'm just going to show you this right now. Give you an idea of what it would look like. So it's going to look like one or the other. Now it's, you know, with some variations, if you will. Let's get there. So if you go down, so let's look at this one. They had warranty expense question. And they also had a product liability question. No, that's a warranty question. It's another warranty question. Long-term debt. See, they had to record the journal entry for the issuance, the journal entry for interest payments, journal entry for conversion, and answer questions about total cash paid for interest and stuff like that over the life of the bonds. If you go back down to the bottom of the exam, you'll see these are the kind of present value tables that I give. All right, so the present value, and there's 4 pages of them. I think they have 4, 5, 8, and 10%. So you get present value of $1, present value of an annuity $1, present value of an annuity due of $1. So only what you need, and nothing more than what you need. All right. So that's what I gave them. And so for this particular exam, they had to do those journal entries, and then for the second part of the exam, they had an amortization table. So for leases, they had to read from the amortization table, record journal entries, and answer some questions. That was their exam. And if we go to the other exam from spring of 14, they had the opposite. So for theirs, had the amortization table, and the first question, so they had to answer questions about the amortization table. And then for the leases, they had to calculate present value, and that's all I gave them, it was in that small chart. They had to calculate present values. This might be the format you get on your exam too, so one or the other, depends on which one I go with. If you have to calculate present value on leases, I'm not giving you all those tables, because you don't need to have all those tables. You'll need those tables if you have to do the present value calculations for bonds. And so they had to record the journal entries for the lessee and the lessor, answer questions about total expenses, total revenues and expenses over the life of the lease for the lessee and the lessor. All right, so you might not get the exact same kind of questions, given that I've now given you a significant amount of information on residual values. You should probably expect to see a guaranteed residual value on your exam. All right, so you'll see they had a guaranteed residual value on, I believe, both of these exams. Certainly on the one with the amortization table. I completely beefed up the information that was on course documents yesterday. If we go to PowerPoint presentations and classroom discussions, this is the Ernst & Young one that we're talking about, by the way. Chapter 14, discussion. Chapter 15, I posted a lot of new information for you. First of all, I put up the Cascade Hardy. This is going to show up some form or another, multiple choice questions, where I ask you conceptually about expenses over time, or actually on your written exam. I'm going to show you what I did. Yes, I had time on my hands. Let's not make this quite so large. So this is the Cascade and Hardy lease amortization table that is actually in the Word document with the solutions. So this is that amortization table, but what I did is I added to that, and down below you'll see a couple of things. First is you're going to see total operating expenses per year for an operating lease, and operating expenses per year for capital lease. So you see the operating expenses per year, it's the same 629.56 straight through, but for the capital lease it changes over time, starting with 760, ending with 450. The depreciation expense stays the same, the interest expense starts out higher, ends lower. For the last year, there is no interest expense, and I wrote a note about that. There is no interest expense for the final year because you made your last payment on the first day of the year, so there's no debt for the final year. And because there's no debt during that final year, there's no interest in it during the final year. And then I gave you a much better picture than the one that I had tried to do in class, which is I gave you the graphic showing the expenses over the life of the lease, where the red is the capital lease and the blue is the operating lease. For the operating lease, steady stream of expenses all the way through, but for a capital lease, starts high, ends low. All right? Remember what I told you about predictability of earnings and, trying to keep your earnings a steady amount over time. Here you see another reason why companies prefer to record things as an operating lease instead of as a capital lease. Right here you're seeing high expenses in the beginning, tapering off to lower expenses near the end. Nice straight line though, pretty much, right? So again, this is something I put up for you guys to look at. I don't want to say the changes. And the other thing, which is really, really important, let's get out of here, is this other document on M&M leasing. I know Nick was saying to me on Wednesday, is there any way you could put up those second set of solutions what you went over in class? I didn't even have time to write down everything that you were saying. So what I did is completely revise these solutions. So now what you see is leases with residual values. Starting out with a situation which we did in class, which is the unguaranteed residual value. So you'll see the unguaranteed residual value. These numbers should pair up with what was in your notes that we went over. Not this part, we'll come back to that part in a minute. all right? And then we have the lessee's side of it. These numbers again match up. We were dealing with an unguaranteed residual value. What I did is I threw some stuff in here for you, and I want you to pay attention to this. And that is, I recorded the journal entries at the end of the lease, where we said what happens when the asset is returned to the lessor. How do they record the termination journal entries? So the asset's coming back. And so I recorded two situations. The asset is worth less than the unguaranteed residual value, and the asset is worth more than the unguaranteed residual value. So you see a loss here and a gain. And then I recorded the termination journal entry here as well. They're simply returning the machine at the end of the lease. But I went further than that. What if the lease was what if the asset, the residual value was guaranteed? How would the journal entries change then? And so I went through everything for guaranteed residual value. And again, what happens at the end of the lease? Again, for the lessee and the lessor. So now you have a really long document here, actually. It's 8 pages. And it completely expands on that one problem that we did in class. So it doesn't just do the initial journal entries, but I did an alternate set of journal entries. So now we have guaranteed residual value, unguaranteed residual value, and you also see the lease termination entries. What happens at the end when you give the asset back? I would say this is now the perfect problem to study from. The only possible scenario that could be layered on top of this one is that it could be a sales type lease instead of direct financing lease, which means you'd have one particular additional journal entry to worry about. All right, the sales type lease looks different. All right, so this, you want to know this one inside and out, and that is also going to pair with, oh my goodness, I didn't post it online. I am now going to get really annoyed with myself. I can go to the Connect website. I have 2 classroom discussion problems that I want to do for chapter 15 right now, and one is that amortization table.
But it's a question. Is it M&M leasing problem for chapter 15, like problem
Yes.
3?
Yeah, I didn't write that out yet. I'm sort of bouncing around, but I didn't write that yet. So that was, all right, so that was problem 2. And then problem 3. Is leases. All right, and so you're either going to be given an amortization table, or you'll have to calculate present values. Let me put this way. Either way, you need journal entries. You need to know your journal entries. Either way. So it's either you're going to have to calculate the present values, or I'm going to give you the table and you're going to have to read off that table. Either way, you need to know your journal entries. Why can't it write now? Strange. So either way, you are going to need to know your journal entries. And for this one, again, the best thing to study is MM and CW. All right, study MM and CW expanded solutions that are on Blackboard. I would also encourage you to study those 2 sample exams, because the sample exam is an amortization table with a residual value, has an amortization table with a guaranteed residual value.
Do you remember which one? That one?
The amortization table with the guaranteed residual value was from fall of 13. And that was actually taken right from a homework problem, which you guys do have. You do have a homework problem. In fact, that I did bring with me. I just didn't bring the problems that I was going to post to the website. So problem 15.2 and 15.8. I don't know if 8 you have homework, but problem 15.2 and 15.8 are the ones that you definitely would need to know. And that I have created solutions. I'm going to put those up on the website for you too, so that you have an idea of what you should be looking at for 15.2 and 15.8. Yes?
What did you say the additional layer on the problem would be for the MMCW research?
Sales type. All right, so I'll put a note. Could be a sales type lease. But I am telling you outright, you will have a guaranteed residual value, all right? I'm telling you point blank, you're going to have a guaranteed residual value. It will not be unguaranteed. That might have been something they had last year, by the way. I should go back and look at that. I think fall of 13, they might have had an unguaranteed residual value. Let me shrink this and go back to that exam. You guys are getting all this down so that I can put these notes up for people.
It's guaranteed. It's guaranteed.
On the sample exam, it's guaranteed?
Fall 2013. The lease contains a guaranteed residual.
Perfect. Because you're going to get a guaranteed residual value. I did do unguaranteed residual value. You don't have that sample exam. I gave that a couple of years ago. It was disastrous. You don't have that sample exam. Okay? You don't want it, actually. It's not like you want to be confused by it. There is, and I'm telling you this right now, it would only, if it did show up, it would be in a multiple choice question. It would not be anywhere else. A sales type lease with an unguaranteed residual value has a very unique adjustment that is made to the initial journal entry on the part of the lessor. All right, the lessor is going to take the unguaranteed residual value out of their sales revenues. Right, so they're going to reduce their sales revenues, and they're also going to reduce their, I believe it's the cost of goods sold. So they're going to reduce those amounts by the unguaranteed residual value. It's a very, very unique situation. I'm not giving it to you guys. It's a more complicated variation. But again, nothing else happens all the way through. All the rest of the journal entries look exactly the same. But that one initial journal entry is a bit of a mess. And the one other thing I want to throw out to you is that I did also go to the FASB and the IFRS websites yesterday to see, what the heck is going on with the new leasing standard. When can we expect it? And yet it is further delayed again. I'm not surprised by this. There's such a battle over this. There's a revised exposure document, what we call an exposure draft. The revised exposure draft was posted a while ago. The comment deadline is passed. They're evaluating the comments. The comments are so strong as to lead us to believe that there might be further revisions that are going to be required. The move, remember I said they're changing the names of it. They're not going to call it capital leases and operating leases. They're going to call them type A and type B now. Whatever. They're calling them type A leases and type B leases, whatever they want to do, I don't care. But basically, the gist of it is that most leases are going to be capitalized. We're going to call that the right of use model. Interestingly, you can see on my website a document that I posted so many years ago. I'm going to look to see if you can tell what day I posted it. I'm actually quite curious. U.S. GAAP versus IFRS, you can't see when I posted it. GAAP and IFRS for leases, and this is a discussion of some differences and and the new exposure document that they were planning on. I wonder if there's a date on here anywhere. It's still relevant. That's my point, is nothing's changed. So this was a comparison of leasing. And I'm just curious, oh, never mind. The point being is that things have not changed. Those differences between US GAAP and IFRS still exist today. So before I get any further in terms of problems, IFRS is not on your written exam. So if you happen to have, have gotten a hold of older exams from friends, they had to do the EY problem from the point of view of the IFRS. That was not on an exam a few years back. I didn't post some of these things because I'm not giving them to you. All right, so you do not have to do anything with respect to IFRS on this written exam. 0. All right, but there might be some IFRS questions on the multiple choice. All right, so that would be fair game. So there is a document talking about, leasing and the convergence. So it's fair game to have a multiple choice question talking about differences. Okay, we did talk about some differences with respect to convertible debt and how that's reported. So that's possible you'll have a question on that. We did speak back in chapter 13 about the differences in the way we record contingent liabilities, right? The loss litigation, the fact that they go to the middle of the range instead of the lower end of the range. The fact that they use 50% as a threshold, whereas we use 70% as a threshold. So there are differences that will probably show up in the form of multiple choice questions, but not on your written exam. Okay, so IFRS is definitely fair game. I would say maybe even more than one IFRS kind of question on the multiple choice. So I think what I've done right now is I've given you a really good focus on where to put your energy into studying for the problems, right? So I've said this before. If you go back to chapter 14, the Tennessee Harvester problem with the amortization table, perfect. The sample exam with the amortization table, perfect. I think it's called the Bradford Exchange problem, where you had to calculate the present value of the cash flows and record the issuance and the journal entries, perfect. All right, sample exam, perfect. So it's going to be one or the other, where I'm going to give you the tables and you have to know your journal entries and how to calculate things, or you're going to have to calculate present values and still have to do the journal entries. Leases, same thing. You're not going to have two amortization tables. It'll be one or the other. All right, so for the leases, again, the amortization table question that I want you to focus on is problem 15.2 and also the sample exam. And then the 15.8, which I don't know if you guys had for homework, but I'm going to post the solutions for it anyway. All right, it's 15.8, which has got very long solutions, and you're not going to have anything that long on the exam. Or the M&M and CW. Really, M&M and CW is bang on, perfect. The only possible variation of that would be that I make it into a sales type lease. Okay? So now I want to just come back to chapter 13 for a minute because of, actually let's open up the sample exam and we'll modify it. Let's see, take the course document, where'd they do? I think they had it on 413. Going to go to here, and I'm going to open up the page, and I am going to use my camera to capture this. The sound works, it's just it won't record me. All right. All right, so I have used this same type of question so many times that I don't want to use the exact same thing again. And it could be the same thing if it was a premium or promotional liability with rebates, whatever. I just don't want to use the exact same darn question again. I want to push you to the next level. And if you look at your last question on the Chapter 13 homework, you see you've got a question from Chapter 20, which deals with accounting changes in estimate. All right, and so warranties and premiums are things where we frequently change the estimate. So let's take this one and see what it would look like the way they solve it, and then we're going to do a revision to that. All right, so for this one, I didn't include the instructions, but what they needed to do is they needed to calculate the warranty expense and the accrued warranty liability at the end of each year. So we'll do this one. All right, so what we have here is sales. I don't have the solutions up, so you guys are going to have to calculate the numbers for me. So 2014 warranty expense is equal to $4,700,000 times 3%. Does anyone have that? 151? 141. Thank you. 141,000. All right, and so then we're going to take the accrued warranty liability. Starts with a balance of 0, goes up by 141,000, goes down by 62,550 for repairs, and so the accrued warranty liability at the end is going to be, what does that come out to? Is that right? 78,450? Warranty at 12/31/14. Right? All right, so now let's take this to the next step. The next step is 2015 expense. Is equal to 5,112 times 3%, which is equal to what?
153,360.
Right?
Yeah, I got it.
Okay, 153,360. All right, so what we're going to do now is we're going to expand this. We're going to go plus 153,360 minus, whoops, I didn't need that. Minus the expenditures of 128,100. And we'll get the balance at 12/31/15. What does that come out to? Okay. That was the answers for it. It should match up to what they have in their answer key, and that would be the end of the problem there. No problem, right?
That's the whole problem.
That was their whole problem. Though they had two parts to it, but this was one of the parts. Okay, I'm gonna erase because I want to change things around here. All right, so what we see here is the warranty liability is 3%, right? Estimated 3% of sales. And what I also had here is I want to change it. I want to make this a 3-year warranty. I want to make it more interesting. Make it 3 years. And then what I want to say is after the end of the first year, really realized that warranty expenses or warranty expenditures, let's put it that way, would be more likely to be 4% of sales rather than 3%. All right, let's do 2014 expense. Well, 2014, we still think it's 3%, right? So we're gonna 4,700,000 times 3%. What did that come out to? 141, right? Accrued warranty liability. Again, we had same thing over here. We just started with 0, up by 141, down by 62.5, and we arrived at what was it? 78,450, right? That part didn't change. Everything's fine so far. But now, all of a sudden, we're finding out the estimate should have been 4%, not 3%. All right, so we're gonna get to 2015 expense. Now that I think about this, this is gonna be a problem. All right, 2015 expense. You're gonna have to do 5112. Times 4%, what does that come out to? Is it 204,480, right? But you also have to pick up the revision from last year. So that would not be the end of it. You would also have to take the 4,700,000 times 4% minus the 3%, because that changed, and those are going to need more repairs. So this is going to be another 47,000. So 251,480. Other than that, nothing else is going to change. So we're going to still go through this way. We're going to have, again, we had the 0, we had the 141, we had the 62,550, brought us down to 78,450. But now this is going to go in at 251,480, and everything else stays the same. We still have to take the other thing out. 128,100 comes out. Somebody have the answer now?
201,800.
Okay, so what's happening is we're increasing our estimate of our total costs. The interesting thing is, because it's a change in estimate, you don't go back and revise what you did in the prior year. You make your revisions going forward. Okay? So, as I think about it, the only thing that changed throughout this entire problem was that one. All right, that was the only thing that changed. So really, this sort of ratcheted up only a small amount, but it makes for one messier calculation. bear in mind, this is an example where there was an increase in the estimate of a warranty. It could actually go down as well. You might say, oh, I don't have to make as many repairs, in which case, this number right here would end up being lower. You still do everything exactly as what you did before. Okay? Yes?
Does the fact that you changed it to 3 years matter?
No, I just did it to show you that it was carrying forward. It didn't really matter. It could have been 10 years or whatever. I just did it because otherwise some people will say, well, the warranty expired. So why are you changing an estimate? Because the warranties on the first year of sales are already expired. Nobody can come back and claim any more additional repairs. So I just made it so it would be more. Yeah.
And if it went down, like the change went down, you would just subtract the 47,000. Like let's say if it was like
Yes,
the other way around?
exactly right. That's exactly right. So if it had gone down from 3% to 2% or whatever, you would be subtracting 47,000 instead of adding it. That's exactly right. So in other words, that would end up having brackets around it. Okay, so that's really the only variation. You're going to see a change in estimate on your exam. Again, hopefully people are recording this. I think what I'll do is I'll type up a summary of what's on the exam so that you guys know what's on the exam, and if somebody wasn't here, they're going to have the benefit of seeing that too. All right? Any other specific questions here? Yes?
Okay, so for problems 2 and 3, you said it could either be journal entries or the table?
Well, it's going to be journal entries no matter what. You're either going to have to calculate the present values, or I'm going to give you the table and you'll get the information from the table.
Okay, and we need to know both perspectives, right? Like lessor, lessee.
Yes,
issuer
definitely
bonds,
lessor and lessee.
And then like issuer bonds and like the receiver
Not the
bonds?
investor, only the issuer. That's a really good question.
Okay, 'cause I was comparing your sample exam to the Bradford problem on Connect, and there was.
And Bradford
it's
has the
different.
investor side of it, and I'm not doing the investor, only
No.
the issuer.
The issuer.
Yeah, let me put that on those notes too. I'm gonna save
Because
these
when I
notes
was
for
looking
my
at it,
own
at
purposes
first
too.
I couldn't figure out what the discrepancy was, and I realized it was a different perspective, so.
Yeah. Alright, so here, this is issuer. Only, not the investor. And on, again, either way, you need to know your journal entries. So the difference is gonna be, am I going to give you the table and you have to recreate the journal entries from the table? Or am I going to have you calculate the present values, and then your journal entries are going to emanate from those calculations? It's going to be one way or the other. Either way you think about it, you're going to have to know how to do an amortization table. Because if I give you a situation where I give you, this is the bond that's being issued, and here you're going to have to calculate the present value of the cash flows, and then you're going to have to calculate the interest expense for the first period. And then to do the interest expense for the second period, you're going to have to be able to do basically the second row of an amortization table. All right, so either way, you're going to have to understand the amortization table. So it's just, for your purposes, when you're given an amortization table, a lot of times it makes it easier because the calculation's already done for you. All right, that actually did not turn out to be the case last year with the lease problem, where they were given the amortization table with the lease problem, because a lot of them did not know what to do with the guaranteed residual value. I am shouting it to you over and over again. You need to know what to do with the guaranteed residual value, okay? It's there, know what to do with it, know that it impacts your depreciation, all right? Know that it impacts the termination journal entries. So they were given the guaranteed residual value, but they didn't necessarily know what to do with it, okay? Yes,
why is
3
it on-
questions actually. Go ahead, yeah.
Why is it on Connect that on the amortization table they would break it up like first just the principal payment, and then like on the next line in the same year would have the principal and then the interest?
Okay, what that has to do with is whether or not the first payment is at
The beginning or the
the
end?
beginning or the end.
Gotcha.
Yes, so if you don't see any interest computed on that first payment, that means the payment was at the beginning of the period.
Oh, okay. So
if
otherwise,
the first payment is at the end of the year, so in other words, you get the asset, but you don't make your first payment until a year later,
right.
then you're going to see only one line for the beginning.
Gotcha.
But if the first payment happens at the initial lease signing and then you use the asset for a year before you make the next lease payment, then you're going to have 2 separate line items because there's no interest computed on the first one. That I think was a twist on last year's exam too. I have to go back and take a look at it, I'm not sure, or it might have been a prior exam that I gave.
Yeah. You can go.
I was wondering if you could post duplicates of chapter 14 and 15's Connect.
Yes, I will do that, remind me if I don't do that immediately, I will definitely do that.
Thanks.
Is the Hardy problem going to be anything similar to that?
The which one?
Hardy problem? Hardy and
Hardy and Cascade is a perfect problem to study from. The only thing I'm going to say is there's no guaranteed residual value in there.
and should we expect all the journal entries that were in the M&M problem?
Yes.
Borrowed for the last one, let's see.
Yep.
Okay.
You're not going to have as many, but I'm not going to tell you which ones you're going to get. So
Okay.
you're not going to have as many, but you're going to have a subset of that. It's only worth 25 points. I'm not going to like hammer you with that.
Okay.
All right, so again, let's just talk about the multiple choice. Again, the multiple choice is going to go up at 4 p.m. on Monday, and it's going to come down at 4 p.m. on Wednesday. We don't have class on Wednesday, so I'm going to give you the full 48 hours to do the multiple choice. It's going to be roughly split between the 3 chapters. I will say that's probably going to be I don't know, I was going to say it's going to be roughly split between the 3 chapters. I haven't done the multiple choice yet, so it's possible that you'll have fewer questions out of 13 and more out of 14 and 15, but I'm going to try to balance them. I'm going to try to balance it so that it's like, you know, whatever, 7, 7, and 8, or whatever 25, 8, 9, whatever it comes out to. 8, I don't know. 8, 8, and 9, 25 multiple choice questions, 40 questions, 40 minutes to do it. Again, no backtracking. Do a question, submit, done. You can't go back to a prior question. You have to have all 40 minutes consecutive so you can sit there and do that. You should be able to open up and look at whatever notes you have, that's fine, but you can't work on it with anyone else. And that's it. If there's any problems doing the multiple choice, just let me know about it. That's all. Okay, so you just stop me, tell me I had problems, stop the exam immediately. Don't let the clock run. If I see that the clock kept running, I don't know how much time you still had on the clock before you ran into trouble. So if you do have a problem executing the exam, you get logged out for whatever reason, don't try to go back in and, you know, unless you're on question 20 and you still have 20 minutes left, that's fine. But I mean, if you get logged out, stop immediately and then let me know so I'll know how much time you spent and how many questions you were able to get to. But really, most people don't have any problems, so I don't want to give you any, you know, cause for alarm on this one. I will answer any questions you have, you know, by email all weekend long, so if there's anything that comes up, you can let me know that too. If you've been recording, send me the recording and I will post it so that the benefit of the people who are at home, Mac and Morgan.
I have a question.
Yes.
So for the bond table, what were the specific problems that we should look over?
Bradford and the sample exams.
Is multiple choice
Is it
all
split?
conceptual?
It's all conceptual. No calculations, except if I add, probably no calculations at all. No, but I could say to you something like this. You know, one bond has an amortization, has an interest rate of 4%, one has an interest rate of 5%, which one's going to sell for more money, or something like that, or whatever, something. You might see numbers, but it's conceptual, yeah.
Are we gonna have to know the journal entries for like writing the comments down?
My God.
That's not on the exam.
I didn't know. Convertible bonds are not going to be on the Oh, see, a little zing right at the last end. Anybody who left doesn't know that right now. Yet I didn't convertible bonds. It's on those last 2 exams, but I didn't realize this exam. It'll be in the multiple choice. You just stay in that extra minute. You got information.
Was there like ending the